Hello there, everybody. Happy Friday. We made it. We made it. You know what? I am here live on the floor. Earlier this morning, it actually was very subdued. It was not too busy, and it's been picking up in the last 15, 20 minutes or so. Volume has picked up. There's a lot of activity now in the S&P 500 pit. So what I thought would be a quiet day to the end here, it's actually picking up, and this is good. In a little bit, so it is, what time is it right now? It's 12 o'clock here, Central Time, at 1:50-ish, so in about an hour and 50 minutes, I'm actually going to be standing right in front of me, directly over there in front of the VIX pit for an interview on Bloomberg, specifically talking about the VIX. If you guys remember to tune in later on. But happy you are all here today. It has been quite an eventful week, especially if you've been following Bitcoin, any of the Bitcoin stocks like Mara, MSTR MicroStrategy, IBIT, the new BlackRock ETF, some real cool, unusual, skewed stuff happening in there. And you know what? With next week's holiday week, typically a holiday week like that can start off really busy, like on a Monday, Tuesday, and then get really quiet for the week because we're off on Thursday. It's full day Wednesday. A lot of people think it's half day Wednesday. It's full day Wednesday. We're off on Thursday, and then a half a day on Friday. So the equity markets, the stock markets close at noon Central Time Friday. So typically we see it volumes really drop off leading up to a holiday like that. However, next week is a huge week for inflation data, for eco data, especially Wednesday specifically. Also, because of the holiday on Thursday, we're going to get jobless claims, the weekly jobless claims number on Wednesday. So Wednesday, we're going to have jobless claims, we're going to have durable goods, we're going to have PCE, we're going to have GDP. So it is I would expect some volatility, and then once that's out, then we could see the drop off. In fact, I would treat Wednesday, folks, pretty much almost like an earnings event where we're going to see some vol picking up going into Wednesday, and then boom, whatever happens, an immediate drop off. So just to prepare you guys, something to think about over the weekend, or when you go to bed Sunday night, about what you're preparing for the week. All right. What are we doing right now? We're up 18 points in the S&Ps, just under 6,000 again, 59.89. VIX is down about a full point today, down under 16 right now. Okay, but don't let that fool you. Remember, that is the spot VIX. If we look out at the futures, especially going out a few weeks, going out to December, January, those futures are sitting around 18. Okay, something that we always talk about, which is so imperative. In fact, if I pulled in any of these traders here, they would really hone in on this and tell you about this as well. Those of you that follow me, that follow Mike especially, we adhere, we listen to the expected move. Why do we use the expected move? For those of you that do use it, great. For those that don't, you're going to use it after today, that's for sure. But I'm going to get into the weeds here a little bit, okay, and really show you how things change as volatility changes and what that has to do with the expected move. Okay, so things that we are going to cover here, obviously, why do we use it? Okay, why is it so imperative to use it? How do we calculate it? Why do we target that short strike? That's right, all of you that are in my room, you're part of the Short Strikers Club. Okay, and then I'm going to do some live examples here, how we look at Vega and IV, implied volatility, in relation to the expected move. Okay, now, first thing, and many of you probably already know this, I don't want to, beat your head with a drum and, keep beating it into you, but some of you may not know this. Okay, the expected move for really anything. If you go back to statistics class in college, if you know about probabilities, okay, the expected move, okay, a one standard deviation move, that's this guy right here, okay? That's this 68% probability, okay? That's what we are calculating when we use the expected move to figure out which options we want to trade. Okay, 68% probability that it is going to trade in that range. Okay, now the expected move is valid for any expiration you use, whether you choose a 1 day, a 0 DTE, a week, a month, 6 months, doesn't matter. The expected move is valid for that. Now, if we talk about a 2 standard deviation move, okay, a 2 standard deviation move, that widens out to a 95% probability of a stock trading in that range. And if we get to a 3 standard deviation move, which in the markets, that's kind of known as the black swan event, those one-off events, now you're talking a 99% probability that a stock is going to trade in that range. Okay, so when we talk about this right here, standard deviation, what the curve means, what the 68% is all about, we're actually referring, okay, to this bell curve. This is known as the bell curve, right? If you remember back maybe when you were in college or one of your kids was in college and, the professor said to you, we're going to curve your grade, right? What did that actually mean? It meant exactly this. And that professor was taking 68%, splitting it right there. And those people got A's, then would move out further and further and further. Okay? Does that make sense to everybody? Because we're actually going to go through some real live examples now, especially on some stocks that have earnings next week. Because we're going to see some moves that are obviously expanded because the volatility is much higher, and we're going to compare that to what the expected move would have been if there was no earnings, if volatility was not all the way expanded like we know it will be. Okay, now, before we do that, why do we always target the short strike? Why do we target when we figure out the expected move? Okay. Why is the option we're trading in our spread, the short option, the one we're selling, why is that always at the tail end? Why is that always at the end of the expected move? Whether it's on the call side, so it's the upper strike call, or on the put side and it's the lower strike put. Why are we always, big trade going on here, 1x2. I got to figure out what this is here, guys. There's a big trade going on right behind me here. I didn't hear exactly what it was, but it was a 1x2. Got to figure out what that was. I will figure it out here in a moment. Hang on, I'm going to actually, I don't know if you guys can see what's going on there. Okay, anyway, sounded like about 1,500 of those traded, so 1,500 by 3,000 of whatever it is. I got to figure it out. Okay, anyway, why do we always target the end of the expected range, and that's the option that we want to sell? Okay, those of you that hear me talking about this incessantly every single day, that's because the optimal place for a stock to move at expiration is to the short strike. Why is that? Because the short strike, exactly, TJ, gives us our max potential gain because this option we sold, the short strike, is going to whittle its way down to zero, while the option that we own holds its value or even increases in value. Okay, let's take a look here. Okay, good, Robert. Exactly. Nick, how you doing, man? Glad you are all here. Glad you are all here. You know what? Let me post this up here real quick before we start looking at some live charts here, guys. Okay, hang on one sec with me here, and let's get, I'm glad I'm doing this now because I missed that there. There we go. Okay, guys. Word of the day, word of the day, word of the day for our wheel. Bell. Yes, that has in relation to the bell curve. Okay? Groucho says bell today. Keep this up here for another 10 seconds, and then we're going to look at some stocks for next week. Look at that expected move and make sure we understand what it actually means. All right. Groucho, bye-bye for now. Okay. So there's a few stocks that I have prepared to look at for next week that have earnings that I think are really good examples to look at. The first one is ANF, Abercrombie, and Fitch. Okay? They have earnings on Tuesday morning. Okay? So first thing, actually, before we look at the option chain here, okay, here's the implied vol. So obviously we know that implied vol here is really jacked up heading into earnings. Okay, it's the uncertainty. Okay, we know that implied vol is going to come crashing down. We talked about this earlier in the week. We talked about that, implied vol crush, the earnings crush. Okay, so let's take a look here. Abercrombie is trading 153 and a half right now. Okay, 153 and a half. Let's focus on the at the monies. Okay, let's focus on the at the monies. We can see, we'll use the 152 and a halves right now. We could use the 155s also, but we'll look at the 152 and a halves. And we can see that that straddle is about, 21 and a half dollars. Does everybody see that? Does everybody see that? 21 and a half bucks. Okay, the other thing I want you to realize, that I want you to notice, where is this implied vol? Okay, this implied vol obviously is really, really expensive, 120% or so. So based on that implied volatility going out to next Friday expiration, okay, if I were to draw our bell curve, okay, if I were to draw our bell curve just like we had up there, and sorry, I'm not a very good artist, okay, we know that this area under the bell here, this is our 68% area. I'm just going to round this off. Stock 153 right now, and we had roughly a $21 expected move. So that would put this here 132. That would put this here 174. That's our range. That is our range. Expected move gives us our expected range. Okay, everybody follow that. Everybody understand that. Where are those fries from, Chew? It smells so good. What's that? Smells so good.
I got a bag for you right here.
No, thank you. Here we go, guys. Look at that. There we go. Thank you. On the live stream here. Boy, if we used to do that. Oh, we got the cheese sauce, too. Boy, if we used to do that, if we used to get caught eating food on the floor here. Huge, huge fines. Thank you. Huge, huge fines. I racked up a few fines in my time down here. Those are really good fries. Sorry, guys. Okay, 132, 174. That's our expected range. If we are bullish, okay, if we are bullish, we want to target upper end, 174. Probably aren't any 174 strikes. There aren't, so we would target 175, maybe 172 and a half. If we're bearish, target the lower end, okay, 132. Now, why is this so imperative to understand? No eating, Bobby. Multitasking. I'm telling you guys, back in the day, I would have my clerks sneak food onto the floor for me because there was no food allowed on the floor, and if you got caught, you got fined, and it was a pretty hefty fine. And I never ever left the floor unless it was like an emergency to go to the bathroom or something. I never left the floor because you never knew when that next trade was going to happen. And if I was, if I was off the floor for 3 minutes and that one trade came in that would have made my day or made my week, that would have driven me, batty. So I would have my clerk sneak food on, and yes, I got caught many times, many times, and got written up for it. Anyway, back to this. The reason we target, as we said, the short strike or the end is because we want that option to be zero at expiration when our long is maxed out. Okay? So let's say we are bullish. Okay? This is not a signal here, guys. Haven't even looked at the charts. We're just doing this for example purposes right now. Okay, let's say we were bullish. We just want to buy a simple call spread. Okay, we're going to target 175. If I paid $1.75 for this, okay, that's what the market is right now on it, probably what you could pay for it. What would our reward to risk be? We always have to figure out our reward to risk. Well, the maximum this could ever be worth is the difference between the strikes on a vertical spread. Talk about this a lot in the class. When we have a vertical spread or an option, whether it's a butterfly, an iron condor, whatever it might be, where all of the options have the same expiration, we can always figure out maximum P&L, where our max reward is, where our max loss is. When we get into a situation where we have multiple expirations, different expirations, calendar, diagonal, whatever it is, okay, we cannot calculate our maximum potential gain. We know what our maximum loss could be, but we can't figure out our max gain. But on a vertical like this, we can. So here, the max this could ever be worth is the difference between the two strikes is $7.50. If I pay $1.75 for it, that means we can make $5.75 on our $175 investment. Okay, $5.75 divided by $175 last time I checked was about 3.3 to 1. That means for every dollar we're investing, every dollar we're putting into a spread, this has the potential reward of $3.30. Does everybody get that? Does everybody understand that? And yes, you must stay until the end to claim your swag. Okay, does everybody understand the reward to risk here? Okay, so this might be a really good spread to put on. But now, why is it so imperative to understand that vol crush? Okay, and further, based on what we talked about earlier in the week, okay, what would you assume this implied vol might drop down to after earnings? Remember what we talked about, how much we can look at each week and what that crush is going to be. You don't have to give me an exact number. You can give me, kind of an estimate, kind of a guesstimate here. What would you expect that vol to drop down to? Oh, Steve, love it. Great. You obviously were listening in earlier in the week. Good job. Good job. Anyone else? Okay, Bear, 50%ish. Yeah, okay. Drop about 50%. Okay. Drop about 50%. Not 40%, drop about 50%. Because remember, this is going to be the front week, right? Because earnings aren't till next week. So these are the first options that will be affected by earnings. So watch what happens. Watch what happens to the expected move if I lower the implied volatility to 60%. Okay? What happened here? Whoop, hang on. Don't want 60 contracts. I want 60 implied vol. There we go. Okay. What happened? What happened to the expected move now? It was, what, $20, right? $21. Now, the expected move is about 11, 12, right? Robert, I think that's right on with close to what I had said of 3.3 to 1. Okay, now that expected move of $11 puts the expected range there. What does that do to the probability of our short option coming into play? What does that do to the probability of our short option coming into play? Put Groucho back up here while you guys are answering that, by the way. Wow, it is busy for a Friday afternoon. S&P's still up 20. We're well over 1,000 contracts. Wow. Come on, anybody. What does that do? Okay, it lowers it. Yes, the probability decreases. Well, isn't that what we want? We want that short option to be worthless. We want that short option to be worthless. Okay? So what that does when we look at that vol crush, it lowers the probability of the option we sold coming into play. Let's look at another one. Another stock with earnings next week, so we can take a look at the difference between where vol is now, what the vol crush would be. Look at the difference in the expected move. This is Urban Outfitters, and yes, there's a lot of retailers next week in the shortened week. Most of the earnings are Tuesday and Wednesday. Nothing on Thursday, and there may be, a couple randoms on Friday, but most of the earnings are Tuesday, Wednesday. Here's Urban Outfitters, URBN. You can see, obviously, again, vol very expensive going into earnings. Okay, stock is currently trading $39. Okay, if we look at next week's option chain here, and we look at the 39 straddle, we see we've got an expected move of about 4.25. Would you guys all agree with me there? about a 4.25 move. So if I draw our bell curve, ding, 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 word of the day, and we put our 39 right here, this right here is going to be 34.75. This right here is going to be 43.25. Okay, if we're bullish, we're going up to the 43. That's the option we want to sell. Maybe we look to the 44. Bearish, we're targeting, we want to sell the 35 or the 34 put. Okay, now, same thing. If we were to normalize the implied vol, meaning calculate it with the vol crush, what should we adjust? What should we adjust this volatility to, guys? In our calculations, what should we adjust that to? Okay, 50, 49, 50. Yeah, right about 50. Maybe I would even make it, 55, because like I said, I always like to err on the side of being conservative, but right around 50. Okay, so if we look to see what these values would be with the post IV crush, $2.25, $2.15 instead of the 4.25. Okay, so now we're here. Now we've got basically, let's call it 36.80 and 41.20. So again, if we had put a spread on targeting the short strikes, okay, pre-crush, this shows that move obviously to be a lot narrower. Okay, we want that short option to expire worthless. Guillermo, there's no link. You either get it on your cable, your direct TV. You can go to Bloomberg.com and watch it online. It's a big news channel, just like CNBC or Fox Business. Michael, we're talking about expected move. We're talking about expected move right now. Okay. Stephen, there are plenty of programs. In fact, pretty much every platform out there tells you what the expected move is. And that's great. That's the cheap way of doing it. But if you really want to get to the next level, if you really want to be a successful trader, you need to understand not only what the expected move means, but really how to calculate it. Okay? Try not to be a robot. Okay? Actually dig in, understand it, and it will help you out dramatically. Okay? And yes, Michael, just like we just posted up there, you can always go back and watch these. They're all of our Market Minds are on our YouTube channel. So any one of them you can go back and listen to. All right, guys, it is that magic time on a Friday for the wheel. S&Ps are still up 17 points right now. All right, Mike, we got our wheel here. Let's take a look. See Charlie Moon messaging me. Why can't there? You didn't post it up yet, did you? Okay. All right, hang with me, everybody. The wheel's coming here. It does, Jay-Z. It does. Now, There are certain times, Jay-Z, if there is a dividend involved, or if there was a stock that might be hard to borrow, those are two different scenarios, that could be off a little bit. But for 90, we'll call it 98% of the time, yes. Oh, good. We're loaded up here today. We are loaded up here today, guys. All right, let's run it. Another French fry. Yeah, sure. Another friend. Maybe that'll be the word of the day on Monday. All right, guys, let's do it. Let's do it. Here we go. Andre, Paul, Francisco. Who's it gonna be? Oh, Francisco. Francisco, are you in the house? Are you in the house, Francisco? Yeah, Bobby, exactly. I don't want to get busted. Smells so good down here right now. The hardest thing was to hide a Starbucks. Francisco in the house. Giddy up. Nicely done, sir. Okay. Don't forget. I forget who it was. A couple days ago, someone did not email me, so I could not send out the swag. Email me, prosperswag at prospertrading.com with your mailing address and the size of whatever it is I'm going to send to you. All right? There we go, everybody. Thank you so much for tuning in. Have a great weekend. Get ready for Thanksgiving next week. It's my favorite holiday of the year. Okay? Again, Monday, Tuesday, I think could be pretty active. Probably get a lot of movement Wednesday morning because of all the economic data, and then it's really going to tail off. Okay, and we'll go through this again next week, but as a review, full day Wednesday, markets closed Thursday, half day on Friday. Okay? Have a great weekend, everybody. Take care.